To build anything that truly lasts, it takes time.
In focus is actually Tata Consumers, which is also trading 1.5% higher as we speak right now. Definitely after that, not a great set. The management commentary remains positive, but let's understand more on that, and let's go across and listen in to Sunil D'Souza, MD and CEO of Tata Consumer Products, in conversation with Aisha Faridi.
Well, let's talk about Tata Consumers' performance, and I've got with me Sunil D'Souza, MD and CEO, joining in on the show right now. Sunil, hi, good morning. Great to have you on the show. It was a mixed bag for you this quarter. While your revenue was in line, one can say that EBITDA and margins missed despite that 6.8% underlying volume growth that you've delivered. Tell me, were there any key cost pressures or mix issues that impacted profitability?
I mean, before I get into the details, yes, we've delivered a decent quarter. I would say 10% top line, group net profit up by 15%, and now we're sitting with close to 400 crores of cash. We more or less have volume-driven growth in our core portfolio. Our growth business, Sampann, is firing up. Ready to drink was volume increase despite the early monsoons. So overall, decent space. Margins, as you rightly pointed out, a bit under pressure, but not unexpected. I mean, we've been flagging off for some time. Last year, tea costs jumped up by 30% because of, I would say, 2.5, 3 droughts, especially in North India. And we've not been able to translate the entire cost increase into consumer price. We've passed on roughly 70% of that, so 30% of that is still an overhang. Our EBITDA was 250 bips lower versus last year. We came in at 12.9 versus 15.4 of last year. And out of that 250 bips gap, 160 bips was accounted for by tea pricing. And the balance was primarily driven by coffee. And now coffee is on a downward trend globally. And therefore, we had some mark-to-market issues, especially in our unbranded business. Nothing that was unexpected. Coffee was probably the, slight bit of a hiccup, I would say. But tea, we knew it was coming. And I wouldn't lose sleep over it simply because we know that it will come back. Tea already compared to the same period last year, the recent auction is about 13 to 15% lower than last year. We do expect overall it to trend to about a minus 20. And if that flows in, that will be margins back to normal. Ready to drink, we've re-indexed our pricing. And this quarter onwards, you should see value and volume starting to fire up. The small bit of transitory issues that we had in Capital Foods and Organic India also more or less on the mend. So yeah, going from here, Q2, Q3 onwards, we see good numbers. Q3, the margin should be back completely.
Right. Yeah, seems like margins could bottom out from here. But I want to talk about the individual segment. And since you delved so much into tea, let's talk about that. Because the market share there, Sunil, has dipped by 80 basis points. Even as India Beverages revenue has grown 8% on a year-on-year basis. Tell me, what's been driving this market share loss? And what is it the plan that you have at hand to try and regain ground when it comes to your core tea business?
So in market share, a couple of points. I wouldn't worry too much about it because, like I said, I've got volume. I've delivered a 12% top line with a 1% volume. So it's not only price, it's price and volume, A. B, Nielsen, you have to remember, and we report Nielsen shares. But Nielsen normally used to reject their panel every 3 years. Now they've rejected it in 1 year. And a couple of points. Nielsen still doesn't add up e-commerce, quick commerce into it. And just as a perspective, e-commerce, quick commerce are trending close to 17, 18% of my business right now. That doesn't feature in market share for Nielsen. In modern trade, one of the big players doesn't share data and therefore Nielsen extrapolates. And like I said, again, they've re-indexed it in 1 year versus doing it 3 years, this thing. We use Nielsen more for the execution metrics and trend analysis rather than absolute market share. So yeah, would I like to see it come back? I would definitely. But would I lose sleep overnight over moment there? I would probably not.
Okay. You talked about transitionary issues impacting growth in capital foods and organic India. Tell me a little bit more in detail exactly what these issues are and when is it that you expect these businesses to normalize?
Let me say a lot of the thesis which we had applied when we did these acquisitions have played out to the T. And when they have played out to the T, there's probably been the last bit of tie-ups which we probably missed, and we've done that during the last quarter. Let me give you an example, right? In Organic India, 40% of the business comes from the US. When we did the analysis, we knew 40% of that US business sits on Amazon. And we ran a few pilots and we could deliver a 30% growth. Of late, we ramped it up to 50%. But what we were not used to is the growth ramping up to 50% in the US and tying up the supply chain. Remember, here we source from all the organic farmers in northern India, send it to the plant, pack it, send it across to the US, and the shipping issues which happened with the geopolitical pieces. So a bit of hiccups out there. I think they had 19 containers land up in July. So I think that we're back to normal. Capital Foods, one of the big theories was that Desi Chinese noodles is a big thing. We went aggressive. And we quickly ran out of capacity. And capacity didn't ramp up as quickly as we wanted, both in regular noodles as well as some of the other variants which we're launching. So we're putting that into place. We right-sized some inventories in some specific pockets, but also then the shipping issues with the geopolitical tensions flaring up in the Middle East and therefore Red Sea becoming an issue. And, some imported ingredients and, India is slowing down imports from certain countries. So we had to reformulate our recipes, so to speak. But more or less, all these pieces behind us, and therefore we remain fairly confident that going forward, we had always been guiding growth businesses will account for 30% of our portfolio growing at 30%. This quarter, we did not, it did account for 28%, but did not grow at 30. But going forward, we remain confident we can deliver that.
Great. I want to talk about pricing also, Sunil, because with favorable tea prices and volatile coffee prices, tell me what is your pricing strategy now when it comes to the packaged beverages and coffee segments for the coming quarters and any price cuts perhaps?
So let me split it into two different pieces. First, I'll talk about coffee. Coffee overall, the big business on the consumer front is the US. The good news is US top line has started to come back, shares have started to come back, margins are where we expected them to be. As coffee prices move down, we do see margin expansion out there. So that's number one. India, we are relatively a smaller player. We're still low single-digit market share, but volumes grew 33% and value grew 67%. I think that puts us in a very, very strong footing here. On the other side, we've got unbranded businesses, plantations and extractions. Extractions is a pass-through business. It's just a question of volume coming back. So margin, I wouldn't worry so much. In the plantation business, yes, we will see a margin contraction, but essentially coffee will go back, I would say, if the trend continues, should go back to where it was margin terms about 2 years back. In tea specifically, you're absolutely right. We passed on around 70% of the cost increases and taken up prices. There is still that 30% left out, but I think a lot of that 30 will come through cost of tea going down rather than me pricing up. And that said, we operate in the gross margin territory of between 34 and 37. We are about 10 percentage points off. Once those 10 percentage points come back with costs going down, I do think then we'll have to recalibrate and take down prices because tea is not a category where I can go for unnatural margins. I have to stay competitive. 34, 37 is the range where I'm competitive. Once it comes in, we will continue to recalibrate. In fact, we calibrate all the time. Even during this quarter, there have been some puts and takes. Some places we've gone up, some places we've gone down. We are very, very agile when it comes to pricing and remaining competitive.
So, Sunil, since you talked about organic India and the US exposure, I wanted to talk about, how the evolving global trade environment actually builds up for you. And are you seeing any tariff-related headwinds in your international tea and coffee and other businesses as well? And how is it then you are mitigating the potential impacts that could play out on both markets as well as, competitiveness?
So if someone tells me this is the tariff today or tomorrow, that is when I can tell you the exact playbook which I'm going to play with, right? It's a moving target. We've drawn up a series of options there, depending on how the tariffs play out. But broadly, here's the story, right? US doesn't produce coffee. All of coffee is imported into the US. So from a competitive space, we will not be disadvantaged. Will there be a category exposure? Yes. Brazil is the biggest producer of coffee, and they're talking about 50% tariffs on Brazilian coffee. Vietnam is 20. I think Indonesia is now about 15. So if this Brazilian coffee of 50% flows through, there will be a category impact. And like I said, competitively, we are not disadvantaged. Similarly, in organic India, most of the ashwagandha, triphala, moringa, all of that goes out of India. So whatever happens on India versus US tariffs will impact everyone, and we will have to recalibrate pricing out there. The broad summary is I don't see a competitive disadvantage, but category there will be issues. We will start moving our playbooks once we know exactly where the dice lands.
Well, ditto to that, we're also waiting to hear out what exactly the quantum of tariffs is going to be, given how it impacts our lives. But Sunil, since you're at a vantage point, and it's been very patchy a consumption trend across your FMCG peers, are you seeing any early signs of rural or urban demand recovery play out? And could that then aid your volume growth in the coming quarters? And also, how do you see your volume across categories pan out for FY26?
So let me say, I do think, and I think I made this comment, we probably bottomed out around October, November last year, and from there on, it's been a gradual recovery, both in rural as well as urban. Rural continues to be strong, and if you look at the recent multiple consumer trends that I've been showing, now urban is starting to pick up pace and move along. I think the one big piece which everyone misses out here is when people are talking, the traditional legacy companies are talking urban rural, they're talking basically the general trade piece and maybe throw in modern trade to an extent. Now my modern trade grew 21%. It's all urban. My quick commerce when I exited, I would say calendar 2024, quick commerce was 50% of my total e-commerce business. Today it's 70%, right? Quick commerce has grown at 97%. And that is all urban. So if I add all those pieces back, we are in double-digit territory for urban and improving. My big barometer for overall consumption is salt. I mean, when I start growing 5% volume in salt, and I grow on total value as well, I'm growing 13% on salt, I think we are in a decent space.
Okay, Sunil, great to have you on the show. Thank you so much for taking the time out and giving us all the insight on where things could be headed next and, of course, how the quarter gone by was. Good chatting with you.
Thank you. Always a pleasure talking to you.
Thanks.